Welcome back to the Personal Finance Project. Today, Scott and I are doing another segment of what has quickly become one of our favorite segments, which is we are going to react to some videos that producers Kira and Hannah have combed from the shadowy corner of TikTok called Fintok, where we get unsolicited, unregulated, and often unwelcome financial advice.
It's very confident advice, though.
Yes, where we find people who are frequently wrong but never in doubt about the things that they are. And it's unsubstantiated, not just unwelcome, but unsubstantiated in many cases. So we're going to do that. We've got 3 videos here. Scott and I are going to give our commentary, and let's get into it. Okay, the first video was called 3 Things Women Need to Know About Money.
Women and money. Can you talk a little bit about that?
So when I was feeling inferior on money, I was like, well, I never went to college. What do I need to know? He's like, Elena, money is simple. There's only 3 things you need to know about money. 1, you got to learn how to earn it. 2, you got to know how to store it, which is different from save it. 2, you store it until you have enough to put into number 3, which is most people don't know how to do, which is to put it into an income producing asset. How do you make your money make babies? How do you make it grow? So earn it, store it, and multiply it. And the multiplying it is by investing it into an income producing asset. So it doesn't depend on my work. That's the only way to go to wealth. You don't earn your way to wealth.
Or save your way.
Or save your way.
All right. So I think the premise of the video, 3 things women need to know specifically about money, I think that video easily could have been titled 3 Things Anybody Should Know About Money.
Yeah.
I think that particularly now where more and more women, as just in a proportion to men, are getting college degrees, graduate degrees, they are frequently earning more than their male counterparts now. I think that women are as sophisticated as men when it comes to money management. And so I feel like there is a bit of they're kind of playing into an old stereotype maybe, where often in cases where people are married, perhaps the man tends to handle the money. But I'd think now that that's typically just not what we're seeing anymore.
Yeah, I think it's well established that we as a gender are on the decline.
Yeah, absolutely. And perhaps to the betterment of I don't know, financial planning.
Society.
Who knows? Yeah, who knows?
But a couple of things to be serious here. One, I was just going to throw out there if we're going to quibble a little bit. I don't think college really has a whole lot to do with being able to manage money. I mean, I guess if you did your student loans and you feel like that helped you to understand how financial planning works a little bit better.
Understand how to get deeply in debt.
Yeah, maybe. But I think even, I guess if you get a finance degree, yeah, you're probably going to understand money a little bit better than when you started. But if you go and do, medicine or humanities or the sciences, I'm not really sure if college is going to help a whole lot.
Yeah, I think if you do accounting or finance or that kind of thing, or maybe, just a general business degree, you probably have a pretty good handle on things like the time value of money, the various accounting principles that go into the corporate management of money. But I think the personal management of money, as we got really in depth into with Mike Antonelli on, is more of a question of your personal discipline. And so I think in this case, her saying you need to figure out how to earn the money, we talked about that at length on the mistakes that people make in their 20s, which is chasing a field where you have no available surrogates, and then maybe you discover you actually hate being a lawyer or a doctor or what have you. And so we felt like earning the money could have been phrased as follow the things where you are talented at, or follow your talents rather than your passions, because I think your passions can often lead you astray. I don't quibble with her basic 3 principles here that she laid out. I think that the fundamentals are often things that a lot of people know, but few people can adhere to. And maybe that's really the point she's trying to make here.
Yeah, I think so too. I am going to kind of, plant a flag and say that store it as the second part of the idea. I don't love that because I feel like it's kind of also buying into a little bit of a trope in financial planning where you can't really make any money until you have some money.
Right.
And I would tell you that I have witnessed and been successful at points in my career putting a little bit of money into a good asset over a long period of time.
Yeah.
And that, they kind of say towards the end, like you can't invest,
earn your way to being wealthy,
or save your way to being wealthy. I would disagree. I mean, I guess we could talk about, what are they saying? $50 million. Yeah, it's tough to save your way to $50 million. You need to have some kind of big liquidity event, but being wealthy, yeah, you can absolutely save your way to being wealthy.
And you and I talked about this just a couple days ago off air, where we were saying that exactly, where if you want to achieve the very highest echelons of wealth, I think in this case it could be deci or centimillionaires. We're talking about absurd sums of money. You will, in almost all probability, have to have taken an inordinate amount of risk, and you'll have had to take an ownership stake.
Yeah, you almost always are going to need ownership.
Yeah, and so, like you mentioned, where you have to have a big liquidity event where you've taken something from nothing, you've built it into an enterprise that is now producing a whole heck of a lot of revenue and ideally profit, and then somebody's willing to buy those cash flows from you at some pretty high multiple, and where you just get all of that present value right away. That's really how you can achieve those highest echelons of wealth. But I also take issue with this notion that you can't just very diligently earn, save, and invest your way to being quite wealthy, because wealth is an idiosyncratic measure. It's saying you don't need to measure yourself against other people. You just need to measure yourself against, do I have future consumption goals that I want to fund? What might those be? And how much money do I need to earn in order to do that? And that doesn't have anything at all to do with what other people are doing.
I agree. And as a last point, I would just add that, and you know, we've touched on this in a couple other episodes, is this infatuation on Fintok or TikTok with income production. And maybe that is her way of just saying into a good investment. And so therefore something with true growth potential is a part of that idea. But I really think that this, you know, fixation with passive income and something that's going to pay you that you don't have to add any money to, I think it's a little bit oversold, and it's probably not very tax efficient in most cases. And I think also it might be leaning you in a specific direction, real estate, which I just don't love for everybody. It works sometimes, and sometimes it doesn't, and not everybody wants to be a landlord.
No, but I think that you're exactly right to spend some time on this, because language here is very important, because she kept saying income producing asset. And maybe some listeners will feel like this is a endeavor into hair splitting or semantics on our part, but I think it's important, because my inclination would be, if I were a person who was working in my field of specialty that was not finance, and I heard a person giving unsubstantiated advice on the internet, perhaps, and they said, really be plowing your money into income producing assets, my thought would be, okay, they're talking about current income, like something that's going to be paying me a huge dividend or a huge distribution.
Big dividends or REITs.
So that I can earn that in parallel to my income. But the thing that we talked about previously was on that other video where she talked about income producing assets, like, okay, is then the notion to be consuming 100% of it? Because that's where I get confused. It's saying, so you're having an asset that's paying you a current income, and then you're immediately just putting it back in? Like, what's the idea here?
It's like you build out the income production first, and then once that's good enough, you can go on to growth. I'm not sure.
I'm not sure what she means. So I think in our view, it's saying she's not entirely wrong. Income producing asset, what we would restyle that to mean is an asset that is going to grow while you are focusing on your endeavor. So appreciation, or assets that have the opportunity or ability to appreciate over time, ideally in a very tax efficient, low cost way, perhaps utilizing some of the accounts that we've talked at length here before, IRAs, Roth IRAs, 401ks, HSAs, all the rest. That's where it would be far more helpful than to say, be plowing all your money into income producing assets. And I think you're right, where most people take that to mean build out your rental real estate empire and live off of the cash flows.
Yeah.
Which for most people serves as just a distraction.
I would tend to agree.
All right.
So this is How to Retire is the title of this one. So let's check it out.
I'm gonna show you how you can retire in 5 years. First, you're gonna buy products on Alibaba, like this diaper backpack for $10. Then you're gonna ship them off to Amazon, and you're gonna sell them over there for profit. As you can see, it sells on Amazon for $46. Within 1 year, you could be making up to $15,000 of profit every month. So I can only imagine what you're going to be making in 5 years. This backpack is making $140,000 every month. And the cool thing about this is that Amazon runs your business for you, so you don't really have to do anything. You're going to have to hustle to get your listing up and running, but as soon as it's up and running and the sales are coming in, it basically runs itself. If you want to learn how to become an Amazon seller, follow me.
Okay. So
I hate so much about this video. You know, I mean, I think it requires that you suspend reality in order to believe that there are this degree of arbitrage opportunities by buying a product on one website and then just immediately selling it on another.
Yeah, I mean that is a basically she's implying there's a 400% margin there,
or that there's just risk-free profits out there to be taken in a process that she's laid out that any layman could possibly employ.
Yes.
Which it doesn't make any sense. It doesn't make sense that you could buy a product on Alibaba, ship it over to Amazon, and sell it for a profit, because the laws of economics would stipulate that given enough time, and this couldn't possibly take that long given how many people are on Alibaba and Amazon, more and more people are going to be buying these bags off of Alibaba, which would indicate that the demand is going to be sufficiently high to raise the price. And then you're going to have this market on Amazon flooded with these bags, which means the supply is going to be sufficiently high to reduce the price.
Going to sell at the same price as Alibaba.
Yeah, I mean, you would ultimately have to have a collapsing of those two prices. So what this leaves out is reality.
Yes, right. Yeah, and I mean, I guess I kind of understand one aspect of it, which is, if, say, you have the ability to purchase things in countries that other people don't, yes, that could be an arbitrage opportunity. But the idea that the margins are so high and this is so easy and that Amazon just takes it over from you and continues to pay you, just naive at minimum, and I don't know what at maximum.
Fraudulent at maximum. Yeah. I don't know. I mean, obviously at the end she's trying to solicit some followers there, so she has an interest in people buying into this thing. And admittedly, I'm as big an ignoramus on this as the next person. I don't know how any of this works, but it strikes me as something that, I mean, anytime something sounds this good, it is too good to be true. It must be too good to be true. And as a perfect joke in this case, my thoughts are, you have a person go out there buying up all these bags on Alibaba, and they are left holding the bag in this case, where now they don't have any.
Might be a diaper bag.
It could be. They don't have any willing buyers on Amazon, and they discover that this worked one time for one specific person in one specific way, but now so many people are piling in on this that it can no longer work. And she doesn't talk about the risks employed here. She doesn't talk about how sustainable these sales are going to be over time. She says this is a business that will run itself, but you really have to, in her words, hustle to get it established. I'm not even sure what that means. But to me, I look at something like this and saying, at its core, you are buying an asset for one price and you are selling it simultaneously, in this case, at a much, much higher price. And it's like, anyone who's taken Economics 101 knows this will not last. It just won't last.
Yeah, and I think also just in the current environment, tariffs aren't going to have anything to do with this. Are you going to have to be paying tariffs if you are then reselling this product, say in the United States on Amazon? It seems like there's a whole bunch of cans of worms that are just absolutely not addressed here.
Yeah, and again, I suppose part of the beauty of this is that you don't have to insure or store any of these products yourself, because Amazon is doing that for you. And yet what I don't understand is, how can there possibly be that much of a profit margin if you are paying all of these ancillary costs associated with doing this business? That's where I fundamentally don't understand it. But again, since I am not currently making $140,000 a month selling bags on Amazon, that should be a good indication that it's not as easy as it looks.
What are you even doing then, Greg?
Exactly. I don't know. I'm in the wrong business, evidently, where if you could be doing this as easily as she says that you could be doing it, more and more and more people would be piling in and doing it. And I think that would certainly erode all of the profits that she's promising you here. And I just don't think it's a sensible plan to retire in 5 years buying bags on Alibaba and selling them on Amazon. It strikes me as a distraction.
I think it's that at a minimum, and something far worse at maximum.
Yep. All right. The next video, I know you've watched the entire thing. It's a bit lengthy. It's on one of our favorite hot button issues, annuities.
Oh, good.
So we got the A word being thrown around here in the personal finance project, but I think it is a good video. So we're going to get into it. We'll probably jump around a little bit, but let's get started.
Yeah, I was going to say, we will go through kind of the main thesis and then see what else we want to touch on.
I'm about to share with you one of the craziest retirement strategies that I have ever done, and it will change your life. No more gatekeeping. The rich know about this. They use it all the time to guarantee themselves income for retirement. So if they live long, healthy lives, They never run out of money. So let me explain how that works. This particular strategy is
I love videos that start with the shadowy wealthy know this strategy, and this person on the internet has discovered it somehow, and they're going to enlighten us more. They're going to enlighten us peons as to what the wealthy individuals are doing.
The cabal of the wealthy.
Yeah, so that we
know
can
this
now get
already.
in on this. So
Yeah.
already intrigued by the video.
Oh yeah, it's a great hook.
Yeah, very, very well done.
called guaranteed income for life annuity. And I'm going to explain what that means. You bring in your retirement account, say that you are 55 years of age and you have accumulated $500,000 in your retirement account. Can be any type of account. Could be an IRA, a SEP IRA, could be a 401k, could be Roth, could be traditional. It really doesn't matter what kind of retirement account, any type of retirement account. You can roll over that account, that money, into something called a qualified guaranteed income, guaranteed lifetime income annuity. What's great about these annuities is when you bring that money in, you brought in $500,000, they're going to give you 10% bonus on the money, and then you get to choose out of two kinds of the rates. The first one is a guaranteed compounding rate of 7% for 10 consecutive years. Compounding rate. This is not simple rate. If you choose the simple rate, it's 8.25% for 8 years. So say that you're 55 years of age and you're thinking you want to take lifetime income, again, guaranteed lifetime income at age 62 or so. The question then becomes, how much income do I get in retirement if I have $500,000 in my account? So let me show you.
Do we want to start with some of this?
Yeah, I think we can kind of jump into it a little bit.
My immediate thoughts on the matter are she has to be talking about a very specific product from a specific carrier where you're getting, oftentimes you'll get a bonus. I know that. I don't know exactly how these work. I should have done a little bit more preparation about how the insurance company will actually provide you a bit of a bonus for your premium that you're paying. And I imagine that's essentially going to be just eroding some of the profit margin that they're going to be getting on these products. That's how they can bonus you. That is not a universal feature with annuities. Just right out of the gate, that's not something that every carrier on every product is going to offer you on a guaranteed income stream. That's just not how it works.
I would agree with you. It strikes me that there's a specific product in mind that this person has decided is the best in terms of annuity, or she has some kind of selling agreement with that
and then
firm.
Yeah, well, that's certainly possible. And then the other thing, and you can enlighten me if you've come across a product like this in all your years of being a financial advisor, 7% compounding interest on guaranteed compounding interest on the $500,000 premium. I have not ever seen anything like that.
Yeah, so this to me, it sounds like a combination of a couple different types of contract. This is clearly a deferred annuity, because she's talking about waiting for 7, 8, or 10 years, and then this compounding growth rate that you can achieve if you wait for a certain period of time. It strikes me as a little bit of a fixed annuity because you are getting a specific rate, but then also a newer product called a buffer annuity, where in those usually that higher growth rate is tied to some kind of market performance.
Right. Yeah.
But it could be that this is like a hybrid product where you have limited your upside to 8%, and so therefore they're going to guarantee that to you in more of a fixed structure. The thing that I would say on this is that these are kind of cold calculations that the annuity company is making in the background. There's not some secret here that she's discovered. If, say, this is some kind of a blended product, what it means is that the annuity company, they're not investing that money. They're buying option contracts that are guaranteeing them a certain result should something happen.
Right.
So should you live for that 8 years, they're going to make a certain amount of money either by buying calls or maybe selling puts, something like that.
Yeah.
Some market performance that's underneath.
And forfeitures from the poor souls who don't live that amount of time.
Yeah, and that is a big concept about annuity. She hasn't touched on this yet, is that if we're talking about just a straight line life annuity, those payments as a percentage of what you put into it are pretty significant, but there is literally no recourse if you pass away 6 months after you start it.
Yeah. And then what do you think about this, where maybe the way that she's getting this 7% compounding is you've turned the capital over to the insurance company. You don't have any liquidity from it. And then in a 10-year period, what they're essentially going to do is double your income base. And so the rule of 72 would stipulate 7% per year for 10 years. You've essentially doubled your contract value, so $500,000 to $1 million. That would roughly get you to a 7% compounded rate of return. But maybe the sort of unspoken thing here is that does not mean you have $1 million that you can use for whatever you'd like. The insurance company is just saying, whatever our prevailing rates are 10 years from now, we're going to double your initial premium, and you can now draw out 5-6% of that for life. And so that would equate to a $60,000 a year income stream at 6%, which would be about $5,000 a month for however long you live. But that's not the same as earning 7% per year on your own money.
Yeah,
because the insurance company has the money. They've got it the whole time.
Yeah, and I guess where I would add that is pretty much every annuity that we use is going to have some kind of return of principal provision or the ability to surrender it after a period of time to get your money back. I don't know. Maybe some of these enhanced growth rates that she's talking about are achievable if you don't have those protections of a return of principal guarantee or the ability to surrender the contract for something else in the future.
Or what they might say is your surrender value when you compare it to your income base, those two things could be very divorced.
Yes,
you know what I mean?
and that's another thing that's very important to consider with annuities is the income base, which is what Greg just talked about, is the amount that the cash flow stream back to you is based on. That does not necessarily mean that the contract is worth that. And I think that both the guaranteed 10% bonus at the beginning that she's talking about and then the guaranteed growth rates, those are on the income base,
right?
Probably not on the actual contract value, which is something you could recoup in the future.
Exactly. So I think to get very clear on how and where this is being credited within the contract is extremely important, because this would indicate, because if that kind of product existed where at 55 you could roll your entire 401k plan or IRA or whatever to a product that was going to promise you 7% compounded for 10 years and you could surrender it for the full value at the end of the 10 years, I would be doing that. Everybody would be doing that. A risk-free 7% compounded where you're doubling your money every 10 years or so, that strikes me as too good to be true yet again.
I agree.
And so I could see a situation, though, where the insurance company is saying, yeah, well, that's credited to your income base, but if you wanted to surrender the contract, you would have gotten, your premium plus some, I would imagine some very low stated rate of promised accrual on that, maybe 2 or 3% over time. That's what you could actually take back if you needed the cash. But if you only need the income, we'll pay it to you. And you can see why. It's because they know most people are only going to take far fewer years of income than they could get if they were to withdraw the entire value of the contract.
Yeah, and I think the question there is, what is the chassis of this contract? If it's fixed, then maybe in the background your contract value is going up 3.5%, 4%. If in the background it's more of a variable or an indexed annuity, then you might not get any growth at all on that 500. It just depends on the way the contract's structured.
On the way it's structured. So I think we addressed kind of these shadowy rich people. Annuities are one of the oldest financial planning tools like ever. I mean, this is just longevity insurance where you're pooling risk as an insurance company. Some people will live to 100, but more often than not, they don't. And so you're really subsidizing people who live a long time with the forfeitures of those who passed away prematurely. That is really kind of the core of how annuities work. And so I think that we've addressed sort of that's not a scheme of the rich.
Yeah, I would tell you if you want to say it's a scheme of the rich, I would say there are some people that have gotten very wealthy talking about how awful annuities are.
That's true.
But they're not saying they're saying don't buy an annuity. So I don't think that fits what she's talking about.
It doesn't really fit. And then I think the other thing we addressed very nicely in that first segment is, how is this being credited? Where is this bonus going? Where are these 7% compounded accruals going? And just based on our experience with annuities, I would venture that these are crediting the income base, but they are not actually crediting what you could get if you wanted to withdraw the entirety of your money out of this contract in a surrender or however you would want to do it.
Yeah, and that would be my assumption as well.
All right. I think you said there's a little bit more content.
Yeah, I think there's a little bit more we can look at here.
All right, here's an example. So this is an example of $500,000 initial premium. They gave you 10% bonus, $550,000. Person's age is 55 years. So at 55, they started that annuity for $550,000. You don't take income the first year. There's usually a wait of 12 months. There's something called immediate annuities, that you could do if you want income right away. But those are not really recommended for some specific reason. Get in touch if you're thinking about them so I can advise you depending on your situation. But in this particular case, it's $550,000. You don't take income the first year. You can take it starting year 2. But let me show you. In a typical example, if you're 55 years of age and you wait until age 62 to start taking your income, because the IRS says up until 59 and a half, if you take income earlier or take money out of those accounts earlier, there is a 10% penalty. So you could start at age 60 or later. Let's say in this case, it's 8 years. So in 8 years, now this account, this $550,000 had been compounding at 8.25% simple interest. At age 62, your total will be $867,625 in total. You started with $550, you have more than $860,000, so it's more than $300,000 really in total benefit that you got in just 8 years because of how great those interest rates are. And those are guaranteed rates. It is not depending on any market condition or anything like that. It is.
I think that kind of gives us a pretty good idea of what we're looking at here, because it's pretty clear that she's got it's an income account.
It's
value
the income account
that is growing. So it is, as we suspected in the prior discussion, where there's no it doesn't appear that there's a guarantee on the principal, which is then therefore what you could do something else with.
Right.
If after 7 or 8 years you decide you don't want an
annuity
anymore. The other thing that I'm seeing here is that it looks like in this particular contract, every year there is a slight increase in the percentage of the income base that you were allowed to take out,
which makes sense,
on a permanent basis. That leads to me to think this is more of a pure annuitization route as opposed to what we run across frequently, which is a guaranteed income rider,
right,
where you're paying the annuity company for some specific percentage at a given time. So say at 75, you can turn it on for 5% or 6%, whatever that number might be. Go ahead.
But again, I mean, we're talking about this would sort of entice a person to wait as long as they could before they started taking income out of it. And the insurance company is using these higher payouts as an enticement, kind of like Social Security, where you get a higher benefit at age 70 than you do at full retirement age than you do at age 62. And people feel like they're gaming the system by waiting. And it's like, okay, you could try that, but they have some pretty high-powered actuaries that are working there. And they have a pretty good sense of how long you might live. So they're not giving you something for nothing. They're essentially making a bet on your lifespan. And they might have a better idea of how long you're going to live than even you do. So unless you're taking some new NAD plus Regeneron, resveratrol combination, and they have no clue that you plan on living to be 120, they're perfectly happy to pay you higher as you defer and defer and defer, because they know that's going to be fewer and fewer and fewer years that they're actually going to be paying these things out. So this isn't alchemy that she's doing here. She's basically just acknowledging the fact that we are mortal, and that if you wait a long time to take a deferred income stream, the income payouts are going to be higher for a shorter period of time, but the total cash outlay by the insurance company might actually be shrinking over time rather than growing.
Yeah, I would agree with you. And I mean, if you're looking at also just what this income base is doing, it's pretty similar to other contracts that we're familiar with. So I would agree with you. It's not alchemical.
It's not doing No. And then the other thing she said, which I want to address here, she said, these rates are guaranteed, this 8.25% crediting method. And it's like, no, it isn't. These things change all the time. And part of the reason we're probably getting a wealth of these kind of videos lately is because short-term rates, or rates on very high quality, I mean credit quality, short duration corporate bonds, which is often what is invested in the general account at insurance companies, what they're getting in interest off of those things is at a not historic high, but in near terms, like short history, high. You know, we haven't seen interest rates on short-term bonds this high for decades. And so it is only sensible now that you're seeing crediting methods go higher, because they have to provide you essentially a spread. They have to give you something for what you're turning over, which is your money, that you could do better on than if you just plugged it into a short duration bond. So this is not going to be true forever. If rates were to decline, you would see an immediate change in what annuities were willing to pay you and credit you on your money, because it's a risk to them now at that time, because they're not earning as much on their general accounts.
Yeah, and I think also the thing that annuity companies do that individuals can't do, it's kind of like health insurance, where they can plan out exactly when they're going to have liabilities, because they know, all right, you're going to start it at some point between, say, 59.5 and 70. So in their general account, like you discussed, they have a specific asset set aside to cover that income stream.
Yeah.
And they do that with hundreds and hundreds, maybe thousands of people. So it's just not rocket science. It's kind of actuarial.
Yeah, there's nothing. I would say watching this video, like I've commented on annuities at length. You've commented on annuities at length. I don't want people to take away from this video that no one should ever, for any reason, at any time, own an annuity. I think that the primary benefit provided by a lifetime stream of income is psychological, not financial. And so I don't think that this is some shadowy tool that only the wealthy know about. I think rather, if you want to live a wealthy life, having your core income needs being met by something that you cannot outlive gives people a high degree of comfort. And that high degree of comfort might allow you to spend the remaining assets that you have that are liquid, so not tied up with the insurance company, on things you otherwise wouldn't have spent them on because you were worried about running out of money. That, I think, is the primary benefit of an annuity. Now, again, not a recommendation, just saying the financials that she's talking about here are pretty pedestrian when it comes to annuity products.
Yeah.
You know, it's not like she's discovered some once-in-a-lifetime golden opportunity here. You just need to be very careful when you're going through these things to figure out, what am I getting and what am I giving up in order to get this income stream?
I agree. And this is a point I've made a couple times on different podcasts. To thine own self be true in terms of an annuity. If you understand that you're not great with money, I kind of like an annuity a little bit better for you, because it is, as she talks about, it's a stream of income you can't outlive. That, however, does not mean you're not going to run out of money. I was joking to Hannah earlier that you might run out of money on the 27th, and then you'll get another check of an annuity payment on the 1st.
Yeah, exactly.
So you might have money, 85% of the time.
Yeah, I mean, unfortunately, it seems as though people who, like, the annuity conversation has gone between people who think you should never, for any reason, ever even consider buying one, or they are the second coming of the Messiah. And it's like, it's probably neither of those things. It's probably just something that you need to, like you said, address yourself and feel like, how anxious of an investor am I? Because if you think about the whole point of retirement, it's you've built up a sum of money, and now the way that you and I would regard risk isn't variance or volatility or standard deviation. It's your inability to fund a future consumptive goal. So that's all that risk is.
The whole question here is, if you didn't do this annuity that she's talking about, how would you cover the $58,000 or $60,000 that you
per year?
Yeah. Like it's a question of, if I don't do the annuity, how am I going to do this?
And
some function of growth and income assets.
How much incremental risk am I willing to take with my own assets? Or how much liquidity or how much of my estate am I willing to turn over to an insurance company so that I can know for sure, hell or high water, I'm going to have this $5,000 check coming in on a monthly basis. Now, that is not a panacea, like you pointed out. If you mismanage that $5,000 and run out on the 27th, you're still left in the lurch. It's not going to solve all your problems. And like I said, I think it's more of a solve for your anxiety rather than for your financials. You're still going to have to be a good steward of the money, but at the very least, it absolves you of one particular risk, longevity risk. You're always going to have this paycheck. It is not, in many instances, going to adjust for inflation. They often leave that to your Social Security benefit to cover you on that front. And so a lot of people are worried, well, what if my spending goes up a ton in the next 20 years? That's a risk you're going to have to be willing to take in order to have this product pay you a lifetime income stream. It's just part of the deal.
Yeah, and it's possible you could then pay extra for some kind of inflation benefit.
Good.
But then we're just back to a present value calculation. Is what you're going to pay for that income increase over time worth what you're going to outlay today?
Yeah, exactly. So again, I think that this installment wasn't necessarily like we react to just horrible advice, because there were some things in here that I thought were just misconveyed, I would say.
When are you starting your dropshipping company?
I mean, I might do that tonight.
Okay.
You know, because I could definitely use the help. You know what I mean? But I don't know. The dropshipping one, misconveyed, because I think there's probably, and that's the difficult thing with these videos, is hard for us to pin down something that is 100% factually incorrect. Because I'd venture all these people could point to an example where their crazy strategy worked beautifully. However, the way that they are, I would say, preaching it from TikTok, there is a self-interested bent there where they want followers, they want clicks, they want to enrich themselves.
They want introductory meetings.
Yeah, and it's like people should feel empowered to do that. But I think our job here and what we're trying to accomplish is bringing a little bit more staid, stodgy, boring advice, and just saying, let's hit this with a cold dose of reality.
I agree.
So
I think we also had a question from a viewer that we were going to finish with today outside of the TikTok realm.
And Hannah was going to come on to read the question.
All right. Our question from our listener is where to save your emergency fund. Right now, and they're speaking about their account, right now it's just sitting in our main account, and I know it shouldn't be, but I don't know if I should put it in a standard savings account or high yield or what.
From my perspective, right off the bat, just based on how debit cards can be compromised, I do not much care for emergency funds sitting in checking accounts. You know, so one, I think that there's not enough friction there. It's very tempting to spend money in a checking account. But two, if a check gets washed and deposited, if your debit card gets compromised, you're sort of left in the lurch while the bank resolves the fraud claim. So you definitely want to move it out of your standard checking account just on those, premises alone, I would say.
Yeah, I would agree. And I'd say that beyond that, so checking account emergency fund, I would think of as if I need something like in the next hour or two.
Yeah.
Because beyond that, we've really kind of expedited, even in my career, we've gone from 3-day settlement on most trades to overnight settlement on most trades. So we've condensed the time that it takes to get into and out of various financial investments. My thought would be that if the bank that you are using for your checking account offers a savings account with at least a couple monthly transfers in and out and a competitive yield, which right now I'd say that's probably something north of 3.5%. Money market funds are yielding something in the low 4s for the most part. So if you could get from, say, a savings account with really easy transferable access, 3.5 or better, that's probably worth looking at.
Yeah. And again, I think it depends on how large your emergency fund is at a specific time and how likely you are to need the money. Hard to say with an emergency fund, but I like to think of setting up enough friction to where you're not tempted to use it as a checking account. So for some people, that means having it at a separate financial institution, because if you can very easily move money from savings to checking, you might be tempted to spend it. I'm just speaking from personal experience here, and you're seeing it every time you're logging into your standard bank in most cases. And that often would just prompt somebody to think, well, maybe we could just a little bit from our savings. And then to your point with the rates, like I'm not one to shop money market rates because this ultimately will represent a fraction of your wealth. And you probably just don't need to squeeze every drop of juice available out of this money in particular. Because remember, your emergency fund is not an investment. So I don't want necessarily people to feel induced to leave that money in place if they need it, where they might be tempted to go into debt to resolve a short-term emergency because I'm earning 4.5% on my money market fund. So, but I think it's important that you don't make decisions that are not in your interest by having it somewhere where you're earning nothing, So I think a high yield savings account, probably on an online bank like Ally or Marcus or one of those other ones, those will do just fine in most cases.
Yeah, and I bring that up mostly to just say, surprisingly, there's still a couple banks out there where the savings account rate is way below market.
Yeah.
And so they're basically kind of just operating as if, all right, rates have moved on, but we're not going to change anything.
I think if I were advising my children, like, hey, here's how you should set up your finances, have a checking account that covers your immediate needs. And I'm talking about, like you said, today's needs that you might need in cash. We talked about the use of credit cards, the responsible use of credit cards, even better, where you're paying that thing off in full every month. Then go to a separate financial institution for your savings, for your emergency fund, only so that you're not constantly looking at it. So you're not constantly pinged like, hey, here's this money. It's just sitting there. It's doing nothing. Because that can give you really needless anxiety about it, because it's really just supposed to be there to serve as a secondary income source to your earnings. That's it. So I would prefer have your standard Chase, Wells Fargo, Bank of America, wherever you're doing your checking, and then set up an Ally, a Marcus, a Goldman, something, or maybe even at a broker, have a money market fund just sitting there, literally doing nothing until you need it. That's the way that I would probably set it up.
Yeah, and I don't have as much of a hang up with having it at the same institution as your checking account, but I think it's all about you.
Yeah.
You know, if you are a person who having it in the same account in savings that's going to be a temptation, then yeah, you probably should do that.
Yeah, so some institutions where house savings accounts were initially set up, and Scott, you can correct me on this, they would typically allow you to do free of penalty like 5 transfers a year. It was some number that if you exceeded that number, you would ultimately have to pay some kind of penalty for doing so. And in principle, I see the merit there, because they're saying this is a savings account. It's not a spending account. It is a savings account where you are to save money. And back in the day where interest rates on these accounts were 10%, and this would have been 80s maybe, that was a reasonable way to store your money. But now where savings accounts pay you like a nickel maybe for having your money in there, you're right. Some of the merits of a traditional savings account where there are still these sort of arcane rules, it's eroded some of the merit of it from my perspective.
Yeah, I would say if you've got a bank, and this is not a dig at any particular bank, if you're at a bank that really, really aggressively limits your transactions and you don't like it, there's somebody out there that will not do that.
Yeah, I think
you could have a different bank that is a little bit more flexible.
Yeah. And again, it's a question of personal discipline. Like Scott's saying, you got your checking and savings account in parallel. You don't mind looking at it because you know what it's there for. But you're also a financial advisor, so you have that benefit, you know? So I could totally appreciate a person not wanting to just look at it every time they logged into their bank, being like, it's just there always.
It's calling to me.
It's just calling always. And so if you need that little bit of separation, that little bit of friction that will prevent you from using it as a piggy bank, just there's so many online banks now that you can put your money in, and it's really easy to set up. It's not a big deal, and it will work just well. It will work just fine for most people.
I agree. Well, everybody, thank you so much for tuning in today as we tackled some more Fintok Reacts. If you enjoyed this content, go ahead and like or subscribe. We're available on Apple Podcasts, Spotify, and YouTube.
Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider it carefully information contained in the prospectus, or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.